Welcome. I am Whitney Roseborough, one of the marketing coordinators here at Squire. Thanks for joining us today for our new lease standard training. Let me introduce you to our awesome presenter today. We have Matt Christensen. He is an audit manager at Squire with 9 years of public accounting experience. He received his Master of Accountancy from Utah State University. His industry experience includes manufacturing and retail, construction, and professional services. Matt has a passion for the new leasing standard and has spent the last 2 years researching and helping clients implement and troubleshoot the new standard. I also would like to point out that we do have a Q&A section where you can enter questions throughout the presentation, and we have Amanda Barrett-Bruff, who is an audit partner, and Stephen Olson, an audit manager at Squire, who will be helping answer those questions throughout. So with that, take it away, Matt.
Okay, thank you, Whitney. So welcome everybody to this quick guide to the new accounting standard for leases. This is kind of like a introductory slides. We're going to go over some very brief topics here. As a disclaimer, this is not an all-encompassing discussion for the new lease standard. So if there are questions or if there are specific examples, we're more than happy to talk about those towards the end or individually with you on a one-on-one basis. So important things to remember. So the new lease standard went live on January 1st, 2022 for everybody who is a December year-end company. For our junior year-end companies, we get a few extra months, so it goes live in July 1st of 2022. Okay. Something to remember is that this can be very easy. This new standard is going to feel very, very similar to the old standard in many different ways. There are some new nuances that we need to go over just to make sure that we don't get tripped up on some of the new terminology, some of the new characteristics of leases. So realistically, and a lot of the clients that we're working with, we have seen that most people are going to have a building lease of some kind that they're going to have to start accounting for slightly differently. And most people are going to have certain copiers, phone systems, fax machines, or other small or light equipment that they lease on a yearly basis that this will apply to. And this is going to be a fairly easy standard to implement. Now, in that same breath, this can be very overwhelming to deal with as well. And there are two things to be considered when dealing with this new standard. And one is moving estimates or modifications. There's a lot of estimation that happens in the new standard that we're going to go over. And differences in those estimates or differences in certain modifications that happen in your leases can create a very burdensome accounting or mathematical load that you're going to have to be able to be aware of and approach on a systematic basis. The other thing that can be very overwhelming is that if you have a large volume of leases. So specifically, without going into too much detail, if you are dealing with a large volume of leases, such as like a fleet lease, like you have many different vehicles that you are currently leasing for your company that are on an annual or monthly rotation and are constantly being swapped in and swapped out for maintenance records or for adjustments or just an as-need basis, this can start to be a very overwhelming process dealing with the new standard. So just be aware, most people are going to fall into this is an easy lease, or this is a very easy standard to enter into. There are instances where it can be overwhelming, but it's okay because we can do this. So again, most of this is going to feel very familiar with the old standard. And as an important note, that you are not in this alone. We are always willing and always able to help look at your current situation and your current fact patterns and say, okay, this is the approach that you should be taking, or this is potentially the software that we need to start looking at to help you address your leasing needs. Okay. As a side note, there's lots of things that in this new standard that are excluded. So we don't have to worry about intangible assets. We don't have to worry about certain things like oil, mineral, gas rights, biological assets. So like if you're thinking like plants or animals, inventory, obviously, and things that are currently under construction do not fall under this leasing standard. So all of those items we can address on other current standards. Okay, so going forward, very high level, what is the difference between the old lease standard and the new lease standard? Okay, under the old lease standard on the left-hand side of the screen, we have a capital lease and we have an operating lease. Okay, so under the old standard, the capital lease creates an asset and a liability. You get to depreciate your asset over time, and you get to recognize interest expense as that liability is slowly paid off on the monthly or annual basis. Now, on an operating lease for the old standard, there is no asset, there is no liability. It's just a payment every single month or year, depending on that certain situation. Now, what the new standard did is it created effectively two new categories. Okay, so the first new category is called a finance lease. Now, this, if you notice, it looks very, very similar to the capital lease model, and that's because it practically is the same as the capital lease model. You have an asset, a liability. They use the word amortization now because it's no longer just an asset. It's called a right of use asset. But interest expense is still applied in a very similar method as the previous capital lease. So that one is going to be very similar and very easy to calculate if you're already familiar with the old capital lease model. Now, the operating lease model, they use the same word going from the old standard to the new standard, but the new operating lease is going to create an asset and a liability on your books that was never previously there. It is also going to be expensed out as a rent expense every month, as opposed to a finance lease that has an interest lease component. So the main distinction between these two leases now is a finance lease is primarily going to be running through as on your income statement as an interest expense, so kind of below the line, whereas on your operating lease, it's going to run through as a rent expense, which is going to be a part of your general and administrative costs, so it's going to be above the line like pre-tax. Okay. Classification criteria. So if we're familiar with our old standards, we had 4 tests to determine whether or not we had an old capital lease or an old operating lease. So a title transfer, purchase option, economic life, present value of minimum payments. These are 4 criteria that are still around. Okay. So under the old standard and the new standard, title transfer has remained exactly the same. If you get the asset, if the title is yours at the end of the day, it is considered a capital lease under the old model, but now a new financing lease. Okay. Purchase option. This one's a little different. Under the purchase option model, the old standard said you had to have a bargain purchase. So if you were able to pay $1 at the end of the life of the lease, that is a bargain. And so under that model, you would be under the capital lease standard. Now, there's effectively 2 tests in this. First, you have to determine, is there an option to purchase? Doesn't have to be a bargain. It's just, is there an option? And second, are you reasonably certain to exercise that option? So this can create a slight difference in how to treat some of our leases going forward. So if we have an option to purchase and we are more likely than not to take that option, now we are in the financing territory. Okay, so we're a finance lease again. So slight difference in the test, but just a small nuance there that we have to be aware of that we can actually go. There's going to be an example later on I want to show specifically about this. So economic life is the third test. The old rule was if you're consuming 75% of the economic life, you've got a capital lease. Okay, new rule is they got rid of the 75% hurdle, and they said that if you are using a major part of the economic life, you have a finance lease. Okay, now major part of the economic life, that is a very broad term, and here's where we start to see some of the new terminology of the standard creeping in with estimates, okay? What does major part of economic life mean going forward? This is a discussion that you're going to have internally and determine what meets that criteria of major part. A lot of firms are defaulting back to that 75% rule as their go-to test, but it's not etched in stone. It's not etched in stone that you have to use that 75% rule. Okay. Minimum payment the present value of minimum payments. So under the old standard, if the present value of the minimum lease payments was 90% of the fair value, you were a capital lease. New standard, they turn around and say, okay, we had an estimate with the economic life. Let's make a new estimate for the present value. So under the new standard, the present value of the minimum lease payments is substantially all of the fair value. What does substantially all mean? Again, this is an estimate. This is something that you have to sit down and say, this is what we're going to be defining as substantially all. Much like the other rule, a lot of firms are defaulting to the 90%, but it's not etched in stone. You don't have to use that as the overriding factor, okay? And then finally, we have a new test, no alternative use code. So this did not exist under the old standard, but in the new standard, they defined that if you are entering into a lease and this item or this service that you're receiving is so specific to you and you alone that no one else can use it, then it has no alternative use and effectively becomes a finance lease. So kind of briefly going over this, if any of those tests, I wouldn't say you fail, if any of those tests are true, that you have a purchase option or you have a title transfer, you're using the economic life, if any of those statements become true, you fall into the financing territory and that you have a financing lease going forward. If you say that all of those are untrue, then you have an operating lease under the new standard, okay? I just want to look here quickly at the Q&A, just make sure I'm not missing any questions. Can you please address how to handle deferred rent and deferred TI allowance credits outstanding at the end of conversion? Yes, that is a great question. So Gary, can I hold off on that question for just a minute? Because we are actually going to address that in about 3 slides. Is that okay? If I don't address it specifically, go ahead and just raise your hand again and I will get back to that one. Okay? Yes. Okay, so wrap it up real quickly on the classification of the new leases. All of these tests are very, very familiar. They just went through and they modified each one of the criteria on the test just slightly in order to fit the new standards that they're creating for what is a finance lease, what is an operating lease. Now, some of these tweaks have some real implications, and I'm going to go into that just here in a couple slides. Okay, so let's talk quickly about adoption of the new standard. Because we have to go live January 1st, or I would say 5 days ago, you have several different options in how your current leases are going to be transitioned into the new leases, okay? I'm going to go ahead and say right now, the easiest methodology is for your old capital leases to directly become financing leases and your old operating leases to become directly new operating leases, okay? In order for that to happen, I'm actually going to skip forward 1 slide. There are some practical expedients that were released in passing this new statement. So there is a handful of these practical expedients that help companies get up to speed on implementing this new standard. And I highly suggest that you take all the practical expedients you can. It simplifies the accounting, it simplifies your life, it simplifies the math, and it's just going to make things better. And so number 1, there's what they call the package. The package has 3 things within it. So one of them is no assessment of expiring or existing contracts, no reassessment of classifications, that's a big one, and then no reassessment of initial direct costs or existing leases. So the really big one is that number 2 of no reassessment of classification. If you take this expedient, if you as a company decide we're gonna implement this new standard, we're gonna take this practical expedient to get us off to the races, this is awesome because I'm gonna go back. It lets you transition directly from capital financing and directly from operating to operating. Okay. Now let me tell you why that's so good. Now I put kind of like there's an arrow because you potentially could have an old capital become a new operating, and an old operating become a new financing. There's that danger zone like that's crossing through there. Anytime that you cross the stream and go from one model to another, you end up having a risk of potentially restating your financials. Okay, because of the way that things are now entering onto your books, you have a potential of having to restate your beginning net asset position, retained earnings, your equity position in order to get the asset and the liability of all these new leases on your books day one. So the practical expedient is awesome because it bypasses that and say, nope, we're not dealing with that. We're not having any restatement. We're going to go directly from one to the new and off to the races. We're good. So there's one thing you can take away from this presentation is that practical expedients are awesome. Please use them. They're going to save you time and effort. Okay. So why is this? Okay. So I wanted to go back. I did mention one thing about a purchase option in the classification. And this is something that we thought, okay, this is not going to be a huge deal. On the right-hand side of the screen, I cut out a certain section of a lease that is very specific of this topic. This lease is pretty standard. It's a 60-month. They pay about $9,000 a month. It gives, here's the total cost of this asset, so they can be able to figure out the fair value. They have an initial rate in here, so they're able to determine their present value. So, Gary, that's another great question. Can I get right back to you on that? Let me finish this thought. Down here on the bottom, there's an option to purchase. Now, if you read through this fine print here, it effectively says that you have to return the equipment that was released with effectively a 20% value of that equipment at the end of its life. So basically they're saying is don't beat it up to the fact that it is worthless. You have to return it with a value. And that value is what you can then turn around and buy it for. Now that's an option. I wouldn't say it's a bargain option, a bargain purchase option. So under the old model, this here passed off as a operating lease. Now, if we think about our criteria from a couple of slides ago, it says that in the new standard, you have to first say, is there an option? Yes. Okay. Are you reasonably sure that you're going to take that option? Well, historically, they have. So now we have a financing lease. So under the new model of this standard, what they were classifying as operating leases are now all going to be financing leases because because it's an option and they're going to take it. We no longer look at this bargain option as the overriding factor. So that was kind of like a really good example of what to look out for on kind of that classification going forward. All right, Gary, I want to answer this question now. What about comparative financials? This is a great question. Okay, so you have two options when you implement this standard. Option number one is that in the year you implement it, you effectively just draw a line in the sand and you have 1 year under the old standard and you have the new year under the new standard. Now, this does require you to have some additional disclosures because you're going to have the old standard disclosures with your new standard disclosures. So your report's going to be a little bit longer, but that is one option you have. It kind of ruins comparability a little bit because certain things are going to exist in 1 year that didn't quite exist in the other, but that's okay. They allowed for that. They said that this is fine in implementing it. You can just implement it in the single year and move on. The other option you have is that you can say, all right, to preserve comparability, you can retroactively apply it to the prior year and effectively restate the prior year's information as if it existed back then, even though you adopted a year after. So that way you have 2 years of the same data, but it does require you to restate your prior year information using the new standard. Most companies that we have seen and most companies that we've worked with so far have elected to just do it in the year in which they adopt the standard and leave the prior year alone, because they're not interested in necessarily restating information that they have given to banks and lenders. So in the current year, even though there's kind of this just disjointed comparability, it's far easier to explain to your lenders this is the effect of the new standard than going back and saying, hey, here's new numbers from last year. Please use these in evaluating. Okay, doing good on time here, just checking. All right, so I want to get through this as quickly as we can. How do we calculate the numbers? Okay, this is where you're going to spend a lot of time. Okay, so we have 2 new things we need to talk about. We need to talk about a lease liability, okay, and we need to talk about a right of use asset. So these are the 2 new things that are created by this standard that have to be shown as separate line items on your financials now, okay? So the lease liability is equal to the present value of the remaining lease payments. Now I highlighted in red remaining because this is very important, because you don't have to go back to the beginning of time for all of your leases and figure out, 20 years ago we were paying $4, now we're paying $30,000 a month. You just say, all right, at this point in time, I have how many payments left and how much do I have to pay on each of those payments. So it simplifies the calculation. It simplifies kind of getting started by only focusing on just the remaining lease payments, which is great. Okay, but we have a present value feature we have to worry about. Whenever you do present values, you have to worry about terms, you have to worry about payments, and you have to worry about a rate. Okay, those are 3 things. On the term, obviously includes your non-cancelable lease period. If the lease says 60 months, okay, 60 months is your non-cancelable period. But you have to also worry about options to extend. And this is, again, where we come into management's estimates. If you have an option to extend, and you are more likely going to take that option, on the day that you sign that lease or the day that you convert all of your leases, you have to take those options into effect and say, okay, maybe we have a 60-month lease, but we're going to take the 2 extra options for another 20 years. So we really have 80-year lease. Okay. Now that's always subject to change. So anytime there's a change in that criteria, you have to reevaluate your leases. Now I do have a side note here about commencement date. Commencement date is important in the calculation and is what is driving a lot of these the numbers behind the scenes. So for lease classification, recognition, and measurement are all determined based on the commencement date. Now, commencement is when you take physical ownership of that asset. Okay, so you could sign it in August, but if you don't get it till December, December's the day in which the clock starts ticking for your calculations. Okay, so payment is the other one. So fixed payments, you pay $5 a month. Termination penalties, if you're going to terminate your lease early, you need to factor that in. Purchase options, if you know you're going to take the option and it's already determinable what that price is going to be, that needs to be calculated in with the payment. Okay, residual value guarantees. So if you have to return an asset in a condition that is greater than you think you're going to return it. So if you beat up this asset and you need to repair it a little bit before you hand it back to them, that would be a residual value guarantee. You need to add that back in. Okay. You also have non-lease components. So this is a very good one. This is something I wanted to touch on. What is a non-lease component? So if you think about, the easiest way to describe this is if you think about a building lease, you have your $5,000 a month that you pay. Then you also have your CAM fee, common area maintenance fee, which is like, we'll say like $300 a day. That CAM fee represents a non-lease component because you are not renting the common area. You're getting the benefit of using it, but that's not your asset, okay? So the new standard says that non-lease components are not included in the payment term when you calculate your new liability, okay? However, there is a exception to that. If you are a non-public entity, you can elect to say that for ease of use, all of those non-lease components are part of the payment term. So it's kind of you can't use it, but you can use it. There's both ways. So under the standard model, they're not allowed. If you're a private company, you can elect to say, yes, they are allowed. So that would basically turn your $5,000 payment a month into a $5,300 payment a month, okay? So discount rate. And I'm sorry if I'm flying through this. I'm just trying to make sure we cover everything in the time we have. Discount rate. So there's kind of a hierarchy of how you assess the discount rate. First, the implicit rate. If it says right on the contract, 5%, that's the rate you use, 5%, okay? Most contracts are not going to say what their actual rate is. So that's going to be few and far between that you're using the implicit rate. The next stage down is the incremental borrowing rate. Now, in the simplest terms, incremental borrowing rate means that if you had to go out to a bank and say, hey, bank, give me a loan for the dollar amount in which I would spend on this lease for the term, for the payment, the number of months that I'm going to be using this same lease, what rate would the bank give me under those similar conditions? Now, that I'm simplifying this a little bit, but effectively, that's what the incremental borrowing rate is. Under similar circumstances, what would it cost me to finance this and then go and buy the item, okay? The risk-free rate is something else that we could potentially use as a discount rate in this present value computation. The risk-free rate is only available to non-public entities, okay? It's another accounting policy election that you have to specifically say, we're doing this. And then once you do it, it must be used for all of your leases, okay? So you don't get to pick and choose. Like once you say we're using the risk-free rate, that's it. Every lease is under the same risk-free rate model, okay? All right, so that, very quickly, that's effectively the formula for calculating your lease liability, or the liability that's going to show up on your books day one, okay? Now on the other side, we have a right of use asset, okay? So we put a liability, we put a credit on our balance sheet. We need to put a debit on our balance sheet as well, okay? So how do we figure out what that debit is? This one's a lot simpler. And the formula for it is very simple as well. First, you start with whatever you calculated for your liability. So if you calculated your liability to be $100,000, you start with your asset at $100,000. Then you add to and subtract from any additional items that you may have to clean up in creating these new leases, okay? So for instance, add to any initial payments or direct costs. So the very first day you sign a lease, they demand like the first payment when you sign, okay? That's an initial payment. So we would increase the asset for that one payment, because your liability, you don't have to pay one payment. So your liability is down one, your asset's up one, okay? The other item is direct costs. So if direct costs are defined as external costs that would not have been incurred if the lease had not been obtained. So most of the time we see direct costs are legal fees that are associated with obtaining a significant lease. So if you have to get through lawyers, you have to get through surveyors, or if you have to get through any kind of professional service to evaluate or help you negotiate entering into a lease, all of those costs, instead of expensing them day one, you get to add them back into your asset and then depreciate them over time, which is really great. Okay, things that take away from the asset. So lease incentives and deferred rent liabilities from old standard. Okay, so Gary, this is coming back to your original question. What do you do about your tenant improvements and your deferred rent liabilities? Okay, So a deferred rent liability first is created under the old standard for operating leases because it's a difference between what you actually pay and what your straight line rent is. So it typically grows to a point and then slowly starts shrinking as you get to the end of your lease term. So if you convert on the 1st of January and your liability is this high on your operating lease under the old model, what you get to do is you get to take that directly off your books as a subtraction from your asset. Okay. So in simple terms, if you go through this calculation and we find out that our liability was 100,000, so it created an asset of 100 grand, we get to reduce that down by whatever is the lease incentive, or sorry, the deferred rent liability to get that off the books. Okay. Now the same can be said about those tenant improvements. So if you have outstanding tenant improvements, those are also subtracted away from that asset. And effectively what we're doing is we're just getting rid of all of the old stuff. We're getting rid of all of the old information that we had to keep track of. It's absorbed into the asset. And then from that point in time, it is then amortized over the life of that lease in order to get rid of it. So it's really nice because it just cleans up all of that mess. All of that noise that we had under the old standard is just absorbed in the asset and we're done. So it's great. So Gary, I hope that answered your question. Okay, so let's make sure we're good on time. Perfect, we're good on time. I wanted to go to an example. A lot of the trainings that I go to, we talk about these fundamentals, we talk about these terms, we talk about the theory behind the new standard. But what I really crave is I want to see it in action. So that's what I'm going to do. I'm going to perform for you live in front of studio audience, a live example of here's how simple it can be. And if I screw up, I apologize because I didn't practice this very well before we started the presentation. So let me switch over to the example. Okay. Amanda, can you verify that they're seeing the Excel spreadsheet?
Yes, you can see the Excel spreadsheet.
Perfect. Okay, so this kind of goes back to this can be very simple. The math can be very simple. It can be very complex at the same time, but I just want to clarify, this is a very simple example that I think every one of you could do very easily. So what I've built here effectively is a single lease. So in the green box here, I created a 36-month lease. We're going to pay $5,000 a month. We're going to have an escalation of about 5% a year. I just picked a rate. I said 5.5. I'm not going to go into why I picked 5.5. It's just a rate so that we can have a good example. And then I also said that we're going to start this lease on the very first day of the year. So we're going to make it very, very simple for everyone. Okay. Now, in the math of this new standard, everything is driven off of first creating a functional amortization schedule for like a piece of debt. Okay, so we're going to come through here in this first section here. I'm going to highlight this first section right here. We're going to quickly just create a standard amortization schedule for a piece of debt. Okay. So I went ahead and figured out, okay, for every single year, here's our $5,000 payment. Next year, here's the escalation. So it's going to be $5,250. Then it escalate again at $5,512. So I'm going to take these numbers and I'm going to simply just add them into this schedule to start creating a simple amortization schedule. Okay, so year 2, we're going to go for 24 months. I'm going to add those in. Year 3, okay, we're going to go from 25 to 36. Boom. Okay, so there's all of the payments that we're going to pay in the 36 months. Okay. Now we're going to need to apply those payments against a liability. So let's calculate what that liability is going to be. Okay, so Excel is awesome because it comes with a standard present value calculator that you can use. So we're going to use net present value. Okay, you had to tell it a rate. So we're going to use this 5%. I made this an annual rate, so we need to actually divide it by 12 just so that it becomes a monthly rate. Then we're going to say, okay, what are all the values that it needs to calculate against? So we're going to highlight up all of these values. Just select that we just add. Okay. So simple present value calculation. We took the term, we took the payments that we're going to get, and we created a rate, and it said, okay, we now have a liability that's going to start at $1,732,000. Sorry, that was not English. Let me try again. At $173,000. Okay, so that is the balance of our liability starting day one. Okay, and that is what our payments are going to be applied against. So let's just start adding in some more formulas here to this schedule, and we can see where things start shaking out. All right, we know that the principal is going to be equal to our payment less whatever our interest amount's going to be. We can let that scroll to the bottom. We know our balance is going to be reduced by whatever our principal amount's going to be. We can let that go to the bottom. And our interest rate, to make this simple, is whatever the balance was times 5.5% interest. Okay, now being live, obviously errors happen here. So let me just double check what went wrong. Yes. Annual interest rate, that's why. Okay, you need to watch out whenever you do these schedules, whenever you do an amortization schedule, you have to watch out between what is considered an annual interest rate versus a monthly interest rate, because that will change how these schedules perform, okay? So if we've done all our math right on this amortization schedule, yep, in month 36, our balance goes to 0. Okay, so we've done the first step of how do we calculate these new assets and liabilities, is we create an amortization schedule. Okay. So what is our right of use asset? So under the formulas that we saw before, the first thing we do is we start with whatever our lease liability is. Okay. So our lease liability is equal to our asset day one. This is good because we don't have any of this extra noise. We're not considering tenant improvements. We're not considering direct costs. We're not considering deferred rent liabilities. So we're just going to make this simple. And in the simplest situation, the asset and the liability are the same number day one. Okay. Now, we need to do one last thing is we need to calculate a straight line rent number. Okay. So we're going to add up all of our payments. Boy, hang on. I apologize again, live. All right, the sum of all of our payments. Okay. Get a little bigger. So we're going to pay $189,000 over the life of this lease. Let's divide that by the number of months we have. So effectively, we should be paying $5,254 every single month. That is our straight line expense that we're going to be using in one of our models. Okay, now let's populate the real fun, the real good stuff. Is what do the financing lease tables look like? What do the operating lease tables look like? Okay, so day one, when you start this process, when you implement, because we figured out what our liability is and what our asset is, that is a very easy entry. So we're going to credit. I go up here to this one. We're going to credit our liability and we're going to debit our asset. That's the first thing we do day one. Great. Everything balances. Wonderful. Okay. Now, the finance lease model, it's going to look exactly like our old capital lease model. So this one's going to be very easy to fill out. So every day or every month, we're going to have cash that we pay. So we're going to credit our cash. We're going to have interest expense that we pay. So we're going to debit that. Our lease liability is going to be reduced by the principal payment or the principal amount of the payment. We're going to put a debit there. Now, here's something we didn't really talk about. So typically under the finance model, we see straight line depreciation or amortization being taken against these assets. Now, every model of amortization or depreciation is available to be used under the finance lease model. So as long as it's GAAP allowed, you can use straight line, double declining. I'm sure there's others, but those are the two really good ones that everyone else uses. So for simplicity, let's just say straight line. Okay. So we're going to take our asset and we're going to divide it by 36 months. Okay. That is the amount of amortization that's going to be applied against our asset. So here we go. That right there is the first month entry that you're going to do under the finance model. Credit cash for $5,000. Debit interest expense for $796. You're going to debit your lease liability for the principal amount of that payment, so $4,200. You're going to credit your right of use asset for $4,800, and you're going to debit your amortization expense for $4,800. Okay. So under that, now I do want to say that you don't have to directly use the right of use asset account when you're starting to amortize or depreciate. You can have a contra account, like a accumulated amortization of right of use asset, in order to maintain a certain degree of separation in your books, but you can go directly against the asset. That's okay. Okay, so now this, I'm going to hard code this just so it doesn't mess up. So now this, we should be able to take this all the way down to here. Okay, I'm going to double check. There we go. So that is the entries every single month for the finance lease. So every month we're going to pay cash. Every month we're going to record interest. We're going to record the principal portion of our liability, and we're going to amortize our asset over time. Okay, feel like this. Yep, this didn't work. We're going to do this. It's live, everybody. Just reminding everybody. There we go. Perfect. Okay. All right. Now let's talk about something new. We only have a few minutes here, so I want to make sure that we get to the operating lease, because this is going to be new. This is where things are a little different. Okay. So let's do the easy part first. Let's book the liability. Okay. Book the liability. It's the exact same liability under both models. So this is something to remember. Whether you're in the finance lease model or the operating lease model, the entry to book your very first day is exactly the same. Okay, there's no distinction between that very first day entry. The only difference is when you start entering into the monthly transactions. Okay, so we're going to start just like the finance model is. We're going to go over and we're going to subtract the cash that we pay every single month. So I'm going to go ahead and drag that all down to 36 months. Okay. Now, here's where we kind of get a little different. Instead of having an interest expense component based on the amortization schedule and an amortization expense component based on our straight line or double declining or whatever method you choose, the expense of an operating lease model is equal to the straight line rent that you should be taking every single month. And that's why we calculated it earlier. So our expense is going to be equal to that number right there. And it is the same number every single month. Okay. So once you have an operating lease set up, you know exactly how much expense is going to go to your bottom line every single month, because it does not change, which that's very nice for consistency base and for projections and for managing expectations and your cash flow. You know that you're going to have that exact same expense in your rent every single month. Okay. Now, lease liability. This is kind of strange, but we're going to be applying the same exact methodology in the finance model in the operating model. So we're going to take from this amortization schedule we created what is considered the principal portion of an amortized loan and apply it against the lease liability. Okay. Now, where does that interest component go? Because we're using the principal component, but we're not using the interest component. So here's what we do. The right of use asset. We do not amortize the right of use asset. It is not an amortization expense every single month. The change in the asset is equal to whatever it needs to be in order for all of your debits and credits to match up. It effectively is a plug every single month, and it absorbs the difference between your interest expense that is calculated in the amortization schedule and the difference between your actual cash expensed versus your calculated rent expense every single month. So in this case, it's going to be equal to, what's it say? So it's going to be equal to, let's see if I get my signs right. I think I got this backwards. 4,000. Hang on. Oh, wait, there. This is what I want to do. There we go. So we're going to add all this together. Going to make it negative. There we go. So your right of use asset changes by whatever it needs to change in order for you to recognize the actual cash paid, the rent expense incurred on a straight line basis, and the principal portion of the lease liability being reduced. So yes, it's effectively a plug. Okay, so this is how simple it can be. Now that we've set this up, this lease that I've created here, whether it was a finance lease or an operating lease, we now have the initial entries to book it. We have every single month of what the entries should be until the end of the life of that lease, and then it's gone. Okay, so this is how simple it can be, where the liability and the asset are exactly the same. It's a very short lease. There's no extras that are attached to it. As soon as you start adding all these extra things of tenant improvements, deferred rent liabilities, modifications, changing in estimates, then this becomes a little bit more complicated, because you could change an estimate halfway through a lease, or you could change an estimate the first day or the last day. And all of that would have a direct impact on what is your asset number, what is your liability number, and potentially, is there an income effect or effectively a gain or loss incurred because of the modification that happened to that lease? Okay, so I'm going to pause here for a second while I move over to my final slides here. So if there's any questions up to this point, I wanted to show you how the rubber meets the road with this new lease and how easy it can be to calculate some of these numbers. Okay, so while I move over, please feel free to ask any questions. Okay.
Matt, did you see that question that came through?
Okay, so Spencer, we have a question. Will this be available on Squire? So this as in the slides or the example workbook that I just quickly created? And I believe the answer is yes to both of those. I can make these available. And if it's not available, I can send them to you. I'm more than happy to.
We will send. Oh, go ahead, Whitney.
We will be sending out the recording of this live webinar will be on our Squire YouTube channel, and we will send the link out to everybody as well as a PDF of the slides.
There we go. Okay. All right. I want to end with, so I have 2 slides left. Luckily, the last one is actually Q&A, so there's really only 1 slide left. And I want to touch basis on modifications. So with our remaining time, we showed how easy some of these lease calculations can be. Now let's talk about how hard they can be. So anytime you change a lease, you change. So let's take, for example, this will be easy. You're leasing office space. Anytime you change the square footage of what you're leasing, anytime you change the term in which you're leasing that office, shorter, longer, anytime you effectively determine that because of an event, a new interest rate should be applied, or the landlord comes in and says, hey, we got to increase your rent by $1,000 a month just because of COVID or times or earthquakes, something, right? Anytime one of those events happens to, like in this example, a single office lease, that is a modification, and modifications have direct impacts on what those calculated numbers are. And the simplest way to explain it is you draw a line at wherever you are in your schedule, you recalculate your lease liability based on the new criteria you have, and then you adjust for the change in that liability through your asset and potentially through your income statement in recording a gain or loss because of the change of what has just happened. Now, these modifications can be pretty easy to get through. Some of them are kind of onerous and very difficult to grapple with, especially if you're dealing with multiple versions. Like I helped a client out recently where they decreased the amount of floor space they were renting in their office and extended their term for an additional 40 months and changed their interest rate all in the same time. So there was 3 things that happened to this lease, which created a massive income effect that they were not ready. They didn't realize was going to happen. So this is just be aware when modifications are involved, just be prepared to rerun the calculations, be prepared to reset the dial on a lot of like your lease work papers going forward and any additional projections you're using with those leases, because it will have a direct impact. Okay, so questions? Yes. Do we have anything from the audience as far as like I covered too shallowly? Anything specific we need to talk about? Are there any questions in regards to things I didn't talk about or mention specifically? I'm more than happy to dive in with these last few minutes. Anything that we need to talk about. I'm just going to go ahead and push this to the last slide here.
Remind me, did you talk about how this impacts consolidated entities and when there's related party leases?
Yes. Yes. Okay, that's a good question. So if you are dealing with a consolidated financial statement where you have multiple entities presenting financial information and then consolidating for a larger group, if you have one entity leasing something to another entity, you will have to go through the calculation for each of the specific entities as a lessor and a lessee, because the 2 models are slightly different. I primarily covered the example of a lessee because that's, I would say, predominantly we're going to see a lot more individuals being a lessee than a lessor. So you have to show in your consolidating workbooks, in your consolidating financial statements, that company A has a lease to company B, and you have to show those on the books, and then those would be eliminated upon consolidation, so that at the end of the day, it's as if it doesn't exist because they are one. Great question, Amanda. Okay. If you have any further questions, please feel free to reach out to me. Please feel free to reach out to any of our team members. I want to reemphasize this, that if you're unsure about what you should be doing or you're unsure about how you should be treating a lease, please feel free to reach out to us. We are more than happy to help and guide you through adoption of the new standard, We're more than happy to help you set up your entries each month. You want to have all the entries ready to go, so that's just an accounting entry every single month. We're happy to do that. So please feel free to reach out to us. You're not alone in this. We're here. So thank you for everyone's participation. And that's all I've got for you.
Awesome. Thank you so much, Matt. This was fantastic. Thanks everybody who entered some questions. Like I mentioned, we be looking for an email from Caitlin Webb. She is in our audit department, and she will be sending out the recording of this presentation as well as the PDFs. And she will also be sending out a link to a survey that you'll need to fill out, and then she can send you a CPE certificate if you need credit for this, for attending. So thank you for joining us.